Thought leadership from PwC's National Office.
Welcome to PwC's Accounting Podcast. I'm Heather Horn. Thousands of companies are gearing up to prepare mandatory greenhouse gas emissions reporting, both in the U.S. and worldwide. This is in addition to the many companies that have already been reporting this information on a voluntary basis. Given the dynamic state of the sustainability reporting landscape, we thought it was a great time for discussion on the judgments and practical challenges in calculating GHG emissions, especially when some of the detailed requirements differ across reporting frameworks. And if you're tuning in to learn about the SEC's new climate rule, stay tuned next week for an entire episode on that topic.
As we see the trend of companies trying to beef up their process, and then they usually start with policies. Like if you have good policy and instructions, and this policy is generally known to everybody in an organization, that people know why they are reporting and gathering this data. They better understand how to do it, right? And then it's followed with establishing proper kind of a supervision controls and so on and so forth. So.
Our guest today is Marcin Olewinski, a partner in our national office who also spends time working directly with companies on their GHG emissions accounting and reporting, as well as their broader sustainability reporting. He has a wealth of perspective on the topic of GHG emissions, and stay tuned for our very insightful conversation. Marcin, welcome to the podcast today. So nice to have you on to talk about a topic that basically anywhere you go with sustainability reporting is top of mind, and that would be greenhouse gas emissions, because it is part of the major frameworks as well as the SEC rule. So as many of our listeners know, a lot of companies are reporting that voluntarily now, but I think there is a different level of attention they are starting to pay as they start to adopt these mandatory frameworks. So perhaps, we've talked about this before on the podcast, but I think it'd be helpful to kind of take a step back and just remind people some of the background and why this is such an important topic.
Hello, Heather. Nice to be here again. Thanks for inviting me. Yes, you're right. I mean, what we've seen before, historically, the GHG emissions were reported for two reasons. First, voluntarily, we've seen that trend on the market that a lot of companies are being either pressured by activists, their investors, or generally want to be good corporate citizens and reporting this data voluntarily. Or in certain countries, you might have various environmental requirements that some industry might be subject to reporting these emissions. Like the best example, in the United States, some industries have to report those emissions to EPA. The similar kind of reporting framework like Clean Air Act rules might be in place in Europe. So we've seen that historically the reporting was for different reasons. However, it was never done alongside the financial statements or financial information. So now we see that the trend is changing, the requirements are changing. Across the globe, those new either proposed or already passed sustainability frameworks will require companies to publish that information alongside the financial statements. And that also drives the very interesting trend, because historically we've seen this information being, managed by environmental teams, investor relations, EHS teams, or ESG, broadly understood ESG teams. Now, because this information might be showing up next to the financial statements, we see way more financial reporting or accounting professionals getting really interested in the topic and needing to learn more about that.
Well, and I think that's sort of the theme of our entire podcast series is this greater involvement of financial professionals in GHG reporting. And so later in the podcast, I definitely will ask you if I was, from financial reporting background, some of the things to focus on. But maybe before we get into that, I think it'd be helpful to kind of set the stage and talk about some of the sort of underlying definitions that you need to know to even start to understand this conversation. And for listeners who do know some of these very first terms, it's definitely going to get more complicated pretty quickly. So,
yes, I would agree. And obviously, when you think about GHG emissions and terms, the first, most important term that comes into mind is scopes. So emission scopes. A lot of, my clients, and my background is financial reporting and auditing. A lot of my clients are asking a lot of questions about what is the difference between the scopes? What is this whole thing with scopes? So, So just to set the stage up, currently the GHG emission reporting is being done based on rules and guidance set out by GHG Protocol, right? So that's the, I would say, framework that a lot of companies are using. And that framework defines or categorizes emissions between three different scopes, right? So scope 1, scope 2, scope 3. And it's very important to understand that, what these definitions mean, what's the distinction between the three, and why? Because various regulatory frameworks may require reporting some of those emissions, but not all of them. So let's start with scope 1. So scope 1 are direct GHG emissions that occur from sources that are owned or controlled by the company. So basically, we're talking about emissions generated by assets that the company owns and controls. What are the examples? Let's say stationary combustion. So if a company owns a fossil fuel powered natural gas or diesel boilers, furnaces, compressors, right? They all, when they burn the fossil fuel, they generate emissions, right? So, and if this equipment is owned or controlled by the company, all these emissions are going to be classified as scope 1. Scope 2 are indirect emissions associated with generation of purchased electricity, steam, heating, and cooling. It is a very interesting category because, as I mentioned before, those are indirect emissions. So emissions do not happen at the company. They happen at the company that generates the power, the heating, the cooling. So power generator company is actually, during the production of power or generation of power from fossil fuel, from non-renewable sources, generally the company who generates this power is generating those emissions. I'm using generate too much, but...
Well, and also to be fair, some companies do own their own generation,
yes.
But this is the much more normal case, is that you're buying it from a supplier.
Exactly. So this is this source is about the purchasing power. So the companies that purchase this electricity, steam, or cooling have to report emissions associated with generating of this. And then the last category is scope 3, and those are all other indirect emissions that occur within the value chain of a company, upstream and downstream. So, for example, emissions associated with manufacturing of any goods that we purchase, like capital goods or consumables that we purchase for our company, right? Or transportation of those goods. This is the example of upstream emissions. Downstream emissions, for example, all the emissions associated with use of our own goods that we sell to the customers, or transportation of those goods. So that one is the most broad, category or scope of emissions. There's like 15 categories within the scope 3 itself. As of now, when you look at this, the level of sophistication or reporting of scope 3, we're not there yet. So we see a lot of companies reporting scope 1 and scope 2, but scope 3, because companies do not own data needed to report those emissions, we don't see so much application of this concept in practice. But it's important to understand this concept because some of these mandatory reporting frameworks will require companies to report emissions. So.
Yeah, I think Marcin's a good point. 2 points I wanted to pick up on there. One is, as you mentioned, it's all based on the Greenhouse Gas Protocol and the major frameworks. So if we think about the reporting in the EU under CSRD and the European Sustainability Reporting Standards, as well as the IFRS Sustainability Disclosure Standards. And then as well, if we think about reporting in California, all of them are at least based on the GHG protocol to various levels. And so I think understanding the GHG protocol is important. We'll talk about a few differences here, but I think going into the differences from those frameworks is another episode. But again, I think the sort of the baseline is the GHG protocol. So just, to point that out. And then I also think from a scope perspective, I'm going to go against what I just said and say that those frameworks that I just mentioned all do require reporting scope 3. And I think to your point about the transition from voluntary to mandatory reporting, it's really important for companies that previously haven't reported scope 3, or maybe you're just new to this in general, to really start to dig in and understand that.
Yeah, and I think fully agree. It's very important, and it's important the companies start early because, as I mentioned, scope 3 has 15 different categories. All these 15 categories that may or may not be material for reporters, because not all of them will have to be material, but they may. So what it requires is companies to really dig into it and understand, first, which of these categories are material to them. Second, what is the underlying data needed to calculate and report? And a third, how am I going to get this underlying data? Because by definition, those emissions occur outside of my organizational boundary, within my value chain. And when you look at a GHG protocol, it provides multiple ways to calculate this emission. So some of that could happen using our own data, but that's the groundwork that companies have to be doing right now to make those decisions, right? Do I have an access to third-party data? Can I validate this data, right? How good the quality of this data it is? If I don't, what is my alternative? How am I going to calculate that? And that's not a small undertaking, right? Especially when you talk about larger multinational corporations. You're talking about operations in different parts of the world. And, that's a lot of data gathering if you haven't done so. And I can tell you, when you look at, what occurs right now on the market, we have clients who report full 15 categories of scope 3 emissions, right? But there's a lot of companies that either did not start at all, or maybe report one or two most material or easy. I would say easiest. I probably use the word easiest. It's a little bit misleading because none of that is easy.
Yes, exactly.
But we see a lot of companies maybe picking and choosing and reporting some, not all that are material. So that's why I think there's a lot of work to be done for companies to meet the requirements of those regulatory frameworks. The good thing is some of them give a little bit more time for scope 3, but
Yeah.
Another thing, and I don't want to go there, but some of them require this data to be audited. So, which is another thing, just companies need to be thinking also about what evidence am I going to retain? Will it be auditable for my attestation provider, or how to really navigate that? So all these things, companies have to start thinking about it now, because you have to really plan the whole approach pretty well.
I know. And we're just on our first 3 terms. We haven't even gotten deeply into GHG reporting, and already so much to think about. But why don't I think we, again, could have a whole episode on what to think about as you're calculating these numbers. But just to keep going from the level setting, a couple more key terms we probably need to talk about before we get in deeper.
Okay. So another 2 important definitions and boundaries: organization and operational boundary. You're going to see those terms a lot, and they're really foundational to reporting of GHG emissions. So let me explain what are these 2 terms and why they're important. So you're starting with organizational boundary. In simple terms, like that a lot of accountants can understand, this is basically, I would say, consolidation method. So determination of organizational boundary helps to decide which operations or subsidiaries need to be included in reporting of GHG emissions. So that's why I think the easiest term for accountants is to use, this is the consolidation method, right? And a GHG protocol provides 3 ways how the emissions could be, how the organizational boundaries could be determined: equity approach and 2 control approaches, financial and operational. Why it is important? Because your emission profile under each of these methods could be even drastically different. It can be the same, but it can be different. So it's really important to understand, what each approach means, how to really calculate emissions, because the outcome of your reporting could be different. And in few simple terms, equity approach is basically the companies report emissions from subsidiaries and operations based on equity share that they have. So let's say I have a subsidiary and I own 20%. I'm going to report 20% of emissions of these operations. If I have a wholly owned subsidiary, I'm going to operate 100% of emissions, which is different from control approach, because the control approaches require companies to report 100% of emissions, irrespective of equity share that they have, from operations that they control. And there's 2 ways: operational control or financial control. I'm not going to go too deep into those concepts, but the most important thing is, you report those irrespective of your equity holdings, right? So that's why you can have a different outcome.
Right. So it's basically all or nothing under those approaches.
Exactly. And the one thing which is important, financial control is very similar to what we are used to in consolidation in financial reporting. So a lot of accountants would be fairly familiar, and that's how the concept was designed. Operational control, which is slightly different, right? So it's important people understand, because if they claim that they're using operational control approach, they want to make sure they understand the concept and they apply it correctly. And second concept, a second type of boundary is operational boundary. So basically, determination of an operational boundary involves identification of emission sources, categorizing them into direct and indirect, and then reporting as a scopes 1, 2, and 3. So, for example, when you're going through this, you first establish your organizational boundary, so all the operations or subsidiaries that you need to collect the emissions data from and report it. Then you go into each of these operations or subsidiaries, and you have to identify emission sources, for example, mobile combustion, so all the vehicles that you have, stationary combustion, so all different type of combustion equipment that you own, or any processes that generate emissions. And then you have to determine which ones of these are direct or indirect emissions and categorize them into scope 1, 2, and 3 and report accordingly.
Well, and I think, Marcin, this is one of the concepts that people get so, I'll use the word confused about, because a lot of people will say, okay, well, I figured out my organizational boundary, so why do I need this operational boundary? And I know you have spent endless amount of time explaining this to different people, but from your perspective, why is that operational boundary so important?
Because you're really telling yourselves this determination of direct and indirect sources is really crucial, and it's slightly, I would say, foreign concept to financial reporting folks, right? Because you not only have to identify which sources you own and control and gather the data, but also you have to determine what is your value chain, right? Mm-hmm. What are those indirect emissions, associated with subsidiaries and operations that you own and control, that you have to start gathering the data. So I think it's really, really critical. And depending how you do this analysis, the outcome is gonna, result in reporting different level of scope 1, 2, and 3 emissions. And we see the people are getting confused about this all the time, especially between scope 1 and 2 and scope 3. Mm-hmm. Making those determination, one of the more common areas when we see these problems, leased asset. Leased asset is kind of the classification between the scopes is really important. And depending on, what organizational boundary you select, it's going to also impact, how you think about your operational boundary, right? And how you classify those emissions between the scope 1, 2, and 3.
Yeah, and it's basically almost like the detail within your organizational boundary. You set your organizational boundary, and then within it, what are the sources? And then those are scope 1 and 2. And what's outside is scope 3. Mm-hmm. Although I know people don't like those terms inside and outside, but simplistically,
yes,
that is helpful. So I know, Marcin, I said earlier, we're not really going to talk about the different frameworks. We've mentioned them some, but I do think it is important here to highlight that organizational boundaries is one of the places where there are significant differences between the different frameworks. Did you just want to hit that at least quickly?
And again, why it's important, because it's going to, you might be subject to multiple reporting requirements. You might be required to report different level of emissions, right? Which is key. So yes, depending on which regulations, they have a different approach to organizational boundary. Let me start with California bills and ISSB, because those two have basically rely on GHG Protocol for determination of boundary, which means the companies have, an option, right? To decide which approach they're going to select. And as long as they apply it correctly and consistently, those standards allow that optionality, right? So, which is not bad solution. Like if company already reports voluntarily, they have a certain approach to the boundary, it would allow them to continue that approach, right? Under those two rules. But then in a contrast to that, proposed SEC rule, for example, that rule kind of requires companies to report using the financial statement consolidation. Which is totally different, right? Could be similar to GHG Protocol, some of those, one of those solutions, but it could be totally different, right? Which basically you report 100% of emissions for all the entities that you consolidate, and your percentage share of emissions from equity method investments and proportionally consolidated JVs, right? And then you move to ESRSs, and that has also kind of a totally different approach. It requires the companies to report 100% of emissions from wholly consolidated subsidiaries, and for unconsolidated subsidiaries like joint ventures, other unconsolidated subsidiaries, it requires reporting emissions from those subsidiaries that company has operational control over. So it's kind of a mixture of two approaches from GHG Protocol. So it is important, especially if you have to report in California or potentially when SEC implements the rule, and in Europe. you might have a totally different answer. So you have to be planning or thinking about this ahead of time, because it is going to require companies to properly establish their processes, controls, and system to gather this information, right? And report on different bases of consolidation. It's almost like for people in energy industry, it's like FERC to GAAP, right? Like people who report, based on a GAAP accounting standards and FERC reporting standards. You have to keep two sets of books almost if you're subject to these two different reporting requirements.
So, Marcin, as you're talking to clients then that are dealing with potentially more than one framework, what do you say is a starting point?
A starting point is, first, you have to understand which framework applies to you.
Okay, fair enough. Sorry. Okay, you figured that out. So now what do you do?
Well, then you have to figure out the organization boundary, right? So, because it's not very small task to do. You have to understand which standard requires, and then you have to go through, your almost consolidation book and decide which subsidiaries and operations need to be included and what emissions going to be reported from. So, for example, you might, let's say you potentially subject to future SEC rule and ESRS. Fully consolidated entities, you're going to practically say, I have the same outcome there. Mm-hmm. But then you have to do the detailed analysis of equity method investments or other joint ventures, because this is when you might have a difference, right? You're going to have certain joint ventures and equity method investments, or all of them, that you're going to be reporting for future or potential SEC rule under ESRSs, right? There are some that you will not have to, right? Because you might determine, I do not have operational control. Hence, going back, that full understanding of different organization boundary and control approaches is really crucial, because the outcome, application of this might result in a quite different outcome and significant difference between the both levels of reporting.
Yeah, so I think then the key under any of them is really that underlying data and making sure you have good records, good flexibility of data and otherwise. But I think one of the questions then that's really difficult that people struggle with, just as a starting point, is just completeness and accuracy of that data. And so I know that's a whole huge topic, but what are some thoughts on that then?
Well, yes, irrespective of which framework you have to report on, that's one of the key and underlying kind of concepts that you have to make sure. Let me step back, right? So I divide companies in two groups: the companies that never reported this data before and companies that reported this voluntarily. I still think both groups of those companies, we have some work to do, right? Obviously, the companies that haven't started or haven't been reporting this, they have a long journey ahead of them, right? Determination of, first, do I have a data? Where does it come from? Designing of the processes to exactly make sure this data is complete and accurate, right? Then even companies that historically, reported, you still have to go through the same task. First of all, your historically organization boundary could be different. So you might not be reporting from parts of your organization. So you have to now figure out, where do I get the data? And second of all, from practical experience. In voluntary market, a lot of this data and reporting, when I work with clients, was not really subject to good process and control. So this is the most commonly asked questions that I'm getting from my clients. What do I do to improve the processes and controls of this data? Now, executives who have to be certifying this data, it's going to be really subject to regulatory oversight. So there's a lot of there's a trend of kind of a worrying about the quality of this data. And why is it important? Because we see these kind of issues of completeness of accuracy of the data, quite often, right? And some of those issues might be benign, right? Simple errors in activity data entry, right? So the people who are gathering and entering this data to calculation spreadsheets on tools, they might not be control-minded folks. So historically, we're not subject to any, control design. So they just simply are not wired that way. And we see a lot of times we have gaps in this data. So companies are trying to design the controls and processes to make sure that there's oversight, that the simple entry errors are caught timely, right? They're not missed. So that's one. Second thing is the way the data is captured right now, from within the organization, but also from value chain. Oftentimes, imagine the multinational company that has 10 different locations across the globe, right? So how the process is scheduled, these locations are responsible for gathering this data and reporting this usually up to the parent. Oftentimes, what we see in practice, folks at locations might not be fully aware what is the data used for, right? They might not be fully aware, that is being used to calculate emissions. And what it means, they might not be gathering this data properly, right? If they think that the data is just simply to analyze the energy consumption, right? They might be making different materiality choices, right? They might be omitting certain types of equipment because a simple fact that they might not fully understand what's the purpose of gathering and reporting this data, right? So we see a lot of these application issues on the ground, and therefore we're not the only ones seeing this. Management sees that, and therefore there's a lot of we see the trend of companies trying to beef up their process, and then they usually start with policies. Like if you have good policy and instructions, and this policy is generally known to everybody in an organization, that people know why they are reporting and gathering this data, they better understand how to do it, right? And then it's followed with establishing proper a supervision controls and so on and so forth. So.
All right. So definitely a lot to think about. But if I could summarize that, it's basically you need to bring effectively a controls or SOX mindset to this data, no different than your financial data.
Well, I'm very careful every time I talk to the clients. We've used the word SOX, but I rather say controls, right?
Yes.
There's a judgment that people, like with everything else, there's a judgment that management has to be done to what level of, where they design these controls or what level of, strength. But the controls are needed, right? In general. And a lot of managements recognize that. Whether this is fully SOXified, as we say, or slightly maybe somewhere in, a less intense level, that's basically the decision for management to be done. And that, it depends on their need to how much assurance and quality they want in their data and when they're going to place their reliance, right? So, but I have a lot of clients who just using this, this term, let's SOXify this data, right? Again, this is also materiality call, which is another thing. We talk about policies, controls, and procedures. Where we see the understanding of materiality concept within this process might not fully be there, and why it's important. Identification of all material sources, right? Now we see more and more financial professionals getting involved and translating the concept of materiality to emissions reporting, because historically those concepts might be sort of understood differently. So we see companies omitting some, sources that maybe individually they're not material, but in aggregation you start seeing things accumulate. So that's another concept that we see a lot of inquiries, how to really think about the materiality concept within the GHG reporting.
Well, and I think one thing, Marcin, we've focused a lot here on voluntary reporting, required reporting, but for a lot of companies, they have set targets and they've communicated that they are going to get to net zero, or they're going to reduce their emissions by 25%, or whatever it is that they're telling the market are their objectives and goals. But if you don't have good data to say how much your emissions are, then your demonstration of progress against your goals is inherently may not be accurate, and that is going to cause other types of issues.
Well, and I would even do the one step back and say without good policies, and why it's important consistency, right?
Right.
Having good policies, especially, right, when you look at setting the baseline or target years, baseline years for the target setting, right, and measurement of progress. There's a lot of things that could go wrong, right? The companies could change, how they account for certain things because it's such a new. So it's really starting process. We have to have a consistent policy. So an application of those policies consistent year over year over year. So that progress measurement is meaningful and factual, right? And it doesn't result from changing the policies year over year. And then you go to the completeness and accuracy of data. And why I mentioned that the policies are important, especially now when we're going to see these new, reporting requirements being implemented, which changes the way people set organizational boundaries. It's really important to figure out how it's going to impact your targets, how it's going to impact your baseline year, because it's a big, I don't want to use the word disruption, but it's a change, potential change. And the companies need to figure it out how they're going to apply that in practice. In order to fully capture those differences, you have to have good policies and you have to have good data.
All right. That's very helpful. So then, Marcin, what other types of issues are you seeing when you think about either calculation or classification?
The first, I already hinted on that, is inputs, right? So we see a lot of issues with inputs into activity data, so energy consumption data, It might be, recalculation of measurement units. It might be data entry issues. Also on emission factors, right? We see in the market it might be inconsistent application of emission factors. For example, using inconsistent data sources for emission factors, not updating the emission factor data sources year over year. So that's the first area, inconsistent or outdated inputs, right? And remember, vast majority of GHG emissions right now, those are calculated based on your, activity data and emission factors, right? So it's really important to have both of them correctly. The second area is misclassification of emission sources, right? So good example would be scope 2 is a purchase electricity. Where do you get the data from? Usually from utility invoices, right? So you have utility provider, but what we see happens on the market oftentimes is those utility providers not only bill you for electricity, but also might bill you for natural gas, right? Which combustion of natural gas is a scope 1, but we see companies sort of mixing the two together and could be including this activity data in calculation of scope 2. The other area is also like how people think about on-site generation, right? Because oftentimes people kind of a mix, it's electricity. Those companies who might have on-site generation of electricity might be thinking, well, it's electricity, it's
so
scope 2.
Yeah.
But let's remember, scope 2 is only purchased electricity. Self-generated electricity, it's scope 1. It's just normal combustion of natural gas, biofuels, or whatever, natural type of generation we have, right? Another thing is what we mentioned before is a base year, right? So base year calculations, we see some issues with that, inconsistent kind of application of policy between the base year and the following years, not reporting base year, which is, let's remember, it's one of the requirements of GHG Protocol is companies should set and report a base year, but a lot of companies are not. Apply inconsistent data for, let's say, emissions factors or so on, or different calculation methodologies. Oftentimes, we also see companies that they don't have really specified policies for recalculations of base year, right? So GHG Protocol requires that if company undergoes through some material structure change, or changes their calculation methodologies, the base year should be recalculated as well. So we see that not happening very, consistently across there. So there's a lot of this. If you grow up in the financial, statement world, you just usually see it's a startup company issue, right? The companies that are just beginning the journey, they might not have good processes and controls. We see a lot of these, I would say, issues that are fixable if you really step back and start with your policies, procedures, and controls. So you can fix those issues pretty quickly, but it still needs to be done.
So Marcin, maybe bringing this together, and I know we've only skimmed the surface on some of the issues, but as you are talking to clients, and particularly, let's say it is a company where they have some processes in place, financial reporting people, or maybe the sustainability people are starting to dig in more because either they are subject to a framework or they are wanting to start to report against the goal or otherwise. Where do you really start in terms of how can I improve this data quality? Because again, if you're getting data, in your example you had, there was 10 locations all over the world. And then if you think about each of those locations probably has 100 or more sources, probably more. And the amount of data multiplies very, very quickly. So how do people sort of start to think about this? And again, which thing do you tackle first?
I'm going to go back to the good old accounting and auditing reference.
Yes.
You really have to understand and document your process. You'd be surprised how many things kind of pop up really quickly once you start documenting on paper, what is my process? What you start seeing, there might be differences between different locations. You might see different application and calculation methodologies, different levels of source data gathering. So I always advise clients, start with mapping your process. So put it on paper. If you want to do it in flowchart, narrative, whatever, just kind of make sure that it's documented. If you once you start digging into that, it's very easy to spot inconsistencies missing data. I give you an example. You have two similar locations, and suddenly you see that one location has like 3 material sources, the other has 4. Natural questions like, well, why I have this difference? If they have the similar nature of operations, what am I missing? There might be a reason and justification, but that drives the question, right? For you and for, from you to people who are involved in gathering and calculating these data. And, they have to step back and think about it, right? So usually what we see as a starting point is inconsistencies, right? So that's the best way to identify those. So once you, really map the process, right, the next step you have to, decide, obviously during the mapping process, you can identify some gaps, right? Whether this is data gaps, calculation differences, inconsistencies, inconsistent emission factors, inconsistent calculations, or simply missing some sources. Once you identify this, then you have to obviously go and figure out how to fix it. But then after you kind of apply those gaps, then the decision you have to make is, how do I set my controls? And that's also a pretty big decision to make, because you could either do it at the level when the emissions are calculated. So at each location, you can also alternatively establish some high level, analytical reviews at corporate office. So there's multiple ways it could be done, but having everything, mapped out and gaps identified and potentially addressed allows you to make those decisions. And I can tell you, I was working with a client who, the first year we identified some gaps, they improved those gaps, and they made a decision to push the controls down to the locations where data is actually gathered, right? Historically, they kind of rely on corporate oversight, but their business model was pretty complex. They had a lot of locations. So it's really, to be fair, it wasn't that easy to do the effective oversight on that such high level. So they made a decision to push it down. And they turned them to analytical reviews, right? So they didn't do like what we call process level controls or transaction level controls. They just basically continue relying on analytics. They just asked people who are responsible for data
and who know the data.
Yeah. The following year, when we came back, the difference was tremendous, right? They identified a lot of inconsistencies themselves. They got some multiple errors in the calculations in scope 1 and scope 3. So having that task done, or this analysis done, and mapping the process and making the decision, I'm going to push it down to the people who know the data. They've seen the return practically, within a year.
Yeah. And I guess, Marcin, it's a really interesting point that now is the time to make these decisions, to make these changes, because I do think there is still some recognition that people are still getting their hands around this, that numbers, there could be changes from year to year as more information is identified and otherwise. But if you fast forward 3, 4, 5 years from now, you don't want to be the company that's saying, oh, well, we changed our process and we identified all these additional sources, so we're, restating prior year information. Yeah,
I think I would fully agree. I mean, I'm not saying it's unconsequential now, but it's much better to do it now versus later when you have all this scrutiny, oversight. And, I'm always saying, like, you're going to find things, right? By definition, you're always going to find things. They don't have to be material, but you're going to find multiple ways to improve, and some ways you can bulletproof your data. It's better to do it now than under the, scrutiny of regulatory regime. So.
All right. Well, that's probably a good note to end on then, Marcin. So definitely appreciate all the insight, and thanks so much for joining me today.
Thank you, Heather.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.